Welcome to Mastering Currency Correlation live trading session with me, Dennis Okari, a member of the Exness team Pro. This is part 2. We had so much fun doing part 1. I trust that you're all doing well. Again, thank you for stopping by for another great and amazing session. So we're going to be exploring the subject of currency correlation, and it's a critical role in improving not just your trading style, but also to equip you to be consistent in the fill markets. And it's all about just improving your techniques of trading forex or trading currencies. So in today's session, I'll expand on the fundamental knowledge from our prior session by getting into advanced methods and practical applications while trading situations. So that's what we're going to be covering today. But just first, a little refresher. If you're joining for the first time or you have no idea what you're talking about, you must have missed part 1. So this is just a continuation. But for your sake, just a quick refresher for anyone who might have missed part 1. We discussed the fundamentals of currency correlation, including how different currency pairs move with respect to one another and how these might be used to optimize trading decisions, your trading style, so to speak. In that session, I remember I gave my views. I talked about my style and how I approach currency correlation and several other basic strategies that have proven successful, at least for me in my trading career. So today I will walk you through some live examples. That's going to be an exciting part. So some live examples of real-time trading and analysis to show you how to use currency correlation effectively, not just to know about it or to just use it superficially, but to be able to be effective in how you use currency correlation. So I'm looking at different screens here, and in a short while I'll be going to the charts, but I just need to emphasize that, my aim is to, and this is before I go any further to discussing the details of what you're discussing tonight. I just want to, first of all, before I even forget, I want to invite who's in attendance, please. You can participate by asking me questions. If you know about currency correlation, or you have no idea what this is all about, kindly just write me up in the chat section any questions regarding this topic you're discussing tonight, and also your experience if you've ever used currency correlation as we proceed through today's session. So my aim and objective tonight is to help you improve on your trading skills, like I said earlier, and look at these concepts with an open mind. I always say no one is an island of ideas. All right, so you can borrow something from me. I can borrow something from you, but ultimately our life journey of discovery and just learning every day. So when it comes to trading forex, we always learn new things every day. There's never an end, or you can ever say, yeah, I'm good with what I'm doing right now. I don't need anything else. You will borrow a concept from one person, combine it to two, see what works for you depending on your trading style, and so on and so forth. So let us begin, shall we? And I will start with this question. Why is currency correlation in forex trading important? Before going to the charts, I just want us to converse through understanding the logic behind it, sort of to form a foundation around currency correlation. So why is it important? Why should you care about currency correlation? And I'll use an example of a good friend of mine. I will not mention the name, but we had a discussion one day. This good friend of mine just trades one currency, just one. So on days when, you don't have anything moving on that particular kind of split, it actually don't trade at all. And I admire that discipline, and it's not so many people who can do that. But we had a conversation around currency correlation. I just, mentioned, is it probable for you to look at what else is out there for you to trade? Because when you're looking at your platform, your trading platform, you're looking at the SNA's terminal, you're looking at the SNA's M2 MT5. On the left side, where you've got the market, where you've got all those instruments to trade, you've got everything that is in there. So it's hard to believe that you will definitely miss something to trade. Even for 3 days, there will always be something.
You really
look
look
for it and you'll know what you're looking for.
You will never know it exists.
So I brought up this concept of currency correlation through bits and pieces here and there. It really opened their mind to understand that there is something else that is out there, that you can trade. And so why is this, so important? I will stick to a number of reasons, 3 or 4 main ones. There are so many others if you go and study yourself. Find why this is so important. The number one thing is risk management, which is one of my favorite topics. So when I talk about risk management in the sense that you're trying to avoid unnecessary risks as you're trading, remember, you are trying to preserve your capital as much as profit is very attractive. You're still trying to manage your risk because you want longevity. You want to trade for a long period of time or for many years. And so when we talk about risk management, as it relates to correlation, we're looking at recognizing positively correlated currency pairs. And when you do that as a trader, you can then avoid opening multiple positions that effectively expose you to a higher risk. Let me repeat that one more time. When you think of risk management under currency correlation, you're trying to avoid making mistakes. You're trying to avoid making unnecessary risk. Trading is risky, but this is unnecessary because when you understand as a trader what to do when you're looking at, for example, positively correlated currency pairs, you will avoid opening multiple positions that will eventually put you on that level, that higher risk level. The number 2 thing that is coming to my mind is diversification. When I'm talking about diversification, you are optimizing portfolio diversification when you're trading. So when you understand negative currency correlations as a trader, this will help you in diversifying trades to reduce risk exposure. All right. So the third thing is being a strategic trader. And what do I mean by being a strategic trader and a strategic thinker and a strategic planner? What I mean is when you look at correlation data, and I love going through the data, by the way, when you go through correlation data, it can inform more strategic trade planning for you. For instance, if you as a trader, you notice that a particular currency pair that you love trading is beginning to, for example, diverge. When you talk about diverges from its typical correlation pattern with another pair, this is when you understand what correlation is all about. This will light signal to you an opportunity to capitalize on the divergence. All right, I know divergence is a different topic altogether, but just understanding correlation and when the data changes, it will help you in planning ahead as you're lining up your trades and what you want to look for. And once you discover that there is divergence in your correlation pattern, then it will give you a signal that is an opportunity for me to capitalize and to profit from this divergence. So the other thing that I think about when I'm talking about currency correlation is it helps to inform you. It gives you that. Data gives you insight, not just about currency pairs, but also the broader market dynamics. When you're looking at anticipating moves in the market, you're looking at basing them on fundamentals. So you're looking at the geopolitics. You're talking about economic indicators. You're looking at event-driven context around fundamentals. So when you understand currency correlation, it will help you in you're even housing your markets analysis, so to speak. All right. So in essence, mastering currency correlation equips you as a trader to have that critical tool so that when you're trading the markets, you make more informed, more strategic decision-making, and potentially, these will of course lead you to be a more consistent, more profitable trader, and your portfolio is going to have that performance. All right, so understanding currency correlation, now that you've dealt with why this is so important, I want to get into understanding currency correlation, and there is a very technical and detailed way of going about it. I will try to simplify this as much as possible. And if you're taking notes, well and good. I don't have them on my screen, but you can listen to me and you can quickly jot down some notes if you want to. So how do you understand Or how do we understand as traders currency correlation? And I'll try to explain it in a very simplified way. Think of traders make when they're treating correlation. That there are a couple of them. I'll just deal with maybe just 3 for now. Then I go to your question. You'll always find many traders will ignore, dynamic nature of correlations. And this is what I mean. Correlations are not static. They keep changing, and they change due to various factors. So the economic events that cause these correlations to change. There is a shift in fundamentals, like a shift in monetary policies, central bank, decisions, changes in market sentiment. All these things are factors that will affect currency correlations. And those coefficients. So a common error that I've seen is assuming that a correlation that worked 1 year ago, we still continue working and being consistent over time, and that's not true. So as a trader, you need to regularly update your correlation data. Very, very That's important. Why I having a trading journal is so crucial, so that you can adjust your strategies accordingly, depending on the things that you're looking at. The other thing is also the misinterpretation of that I'm talking about. So you'll find that traders who will misunderstand what currency correlation coefficients imply. So a high positive correlation does not necessarily guarantee that the pairs will move in the same direction and that all market conditions, that's not true. So what you need to note is sometimes market will react depending on what's happening, like a total fundamental sentiment and all that. So the fact that the pound dollar and the euro dollar doesn't necessarily mean you drop to a 15-minute time frame because GPUSD is buying. I automatically buy. Things change. So you need to be adaptable to these changes. And the other thing that, the last thing I mentioned 3, you also need to look at historical correlation data to help you get that predictive value. It's important. But remember, there are historical patterns that can be disrupted. All right. And that's why you'll see those extremely long candles. And if you're a trader and you fail to account for this, over-reliance of historical correlations, then you'll find yourself unprepared. So you need to have a confluence of factors before you buy or sell. Correlation is just one tool that I'm giving you. You also need to deploy the other tool. So a better understanding of the market will be very, very, very critical. So before I wind this session up, I think I'll have like 3 minutes. I just go over your questions, and I think I am looking at some of your questions that you asked here. Let me see what we have. I'll try to answer them as quickly as possible because of time. Thank you so much for those of you who have been, watching this from the time we started. And there's a question here about, let me see, when it comes to price correlation. Why does that gold respect the DXY strength? Very, very interesting. I spoke about DXY earlier in relation to the euro-US dollar. What I would say is the relationship is still talking about currency correlation, the relationship between gold prices and the US dollar index has always been fascinating. It's always been very intriguing in so many different aspects, because what you will find is that when you're looking at gold and you're looking at the dollar index, sometimes it seems counterintuitive when gold does not respect the strength of the dollar, so to speak. And so to understand this, you might want to recognize that a couple of indicators that represent the general feel of why this correlation between the gold and the dollar are hard to ask. So we all know that gold traditionally is used as a safe haven. All right, it's a safe haven asset. And what you'll find is most traders or even investors, will more often than not turn to gold during times when you've got, economic uncertainty. There's tension in this, geopolitics, that region, the high inflation, and so on and so forth. So gold is used as a store of value, or the hedging against currency devaluation. So when you're looking at them, the US dollar index, it measures the strength of the US dollar or the US economy, against a basket of all these other major currency pairs that, you'll traditionally trade. So typically what you'll find is a stronger US dollar index means that there's a higher value of the DXY making the dollar than a denominated assets, and when we turn to gold then, it becomes more expensive to buy gold for holders of other currencies, so which then means it would decrease the demand and, for gold and lower the prices of gold. There's that very interesting relationship. There's so many reasons, for non-correlation. I will not get into all those details, but there are times when gold does not follow, this unbiased correlation with the DXY. And like I say, the economic indicators that cause this to happen, there's market sentiment, there's the stuff like correlation, that affects this. I don't know whether. Let's see if you can see, I'm looking at the questions now full screen, so let me see if I can. Another question right here. So the other question that I think I saw was an earlier question. That somebody asks about, just scroll through this very quickly. How can one become a profitable trader on this financial crisis? Well, I think the first thing you need to do is understand, again, it's fundamentals at the end of the day. Just understand the market cycles. Familiarize yourself with, a lot of these insights. The economic health and potential market shifts when you're looking at one currency pair, which is the dollar, that's the US you're looking at. If it is the euro, you're looking at the New Zealand dollar, it's, New Zealand. So understand the crisis first. It's important to analyze the specific causes for the crisis to begin with, and the effects of this crisis that will lead to you then making that decision. Do you want to buy or do you want to sell? Because your decision will be based on the causes of the crisis in the first place. So I will not want to go into a specific one as an example, but I think you get my point. For you to really understand all these different sectors and the uniqueness of these different markets. So if it's a financial crisis, who is it really affecting? Which region is really greatly affected, on which country is greatly affected, and that will help you a lot. Let's look at another one. It has been going down for more than 2 months. Any forecasts it will rise up? I actually, this is interesting. I talked about, let me just drop it down on the charts. Last year we had something interesting happening with the yen. And, I remember I wrote about it. Let me just look for the USD GPI. If I go back to my full screen, yes, let me go back to this. If you look at the yen, so that's where we are. I hope you're not asking me whether it's going down or whether it's going down, so that you make a decision to enter the market or not. This is what the yen on a daily time frame, this is what you've been having. So if we drop down to the weekly, the market has just been going up. Since when I look at 2021, right after COVID, this market has just been going up and going up and going up. So anything that you see as bearish, these are basically the markets retracing, and sometimes you'll see the markets correcting themselves before they can continue in the original journey. Alright, so George, I hope I've answered that question. To be honest, not now. It will still continue going up, but at some point it will go down. Alright. So with 4 correlated pairs, is it only one trade that I will take? Namo Forex, thank you so much for the question. Namo Forex, to answer that question, the answer is no. If you remember what I said earlier when you're looking at trading, all these correlated pairs, whether positively or negatively correlated, what you want to pay attention to is risk management. And if you want to trade 4 pairs, you can even 6 pairs. You can even 10 pairs. Question is, look at your account size. So if, for example, you have 5, if you have in your example that you've raised 4 correlated pairs, and they're all going in the same direction. Now, what you're doing is, depending on your account size. Again, if one pair goes down, your other 3 are definitely going to go down if they're all going in the same direction. So my advice is, depending on your risk appetite again, depending on your account size, be very careful when you pile and you dump all these currency pairs on your trading platform. That you're buying and selling. You don't want to do that. You want to spread and, in the spirit of Diversifying your portfolio, you still also want to manage your risk as you're doing that. So you wouldn't want to go all hammer and nail. I wouldn't advise for you to if you're experienced or professional. Don't go that direction. Take it a step at a time. Use 2 pairs, then move to maybe 4 pairs, but look at different pairings. You're not. You don't have to go in the same direction. Marcion 1254. Thank you, sir. Totally understood. Thank you so much. See, this session more is highly appreciated. Thank you, Marcy. Understood. Bocarberry Evan, great presentation. Thank you so much, Bocarberry. Thank you, guys. Do I have any other questions here? Greetings, sir. I'm Noel from Initial Ambition. My question is if there is a platform or tool that correlation strength, volume, percentage among different currency pairs. All these things are free on the internet. If you go to the internet, you will just find them. If you want to do more study on currency correlation, can always go there, check out, all the different tools that Exness is offering on your platforms. When you go to your terminal, you will see all kinds of things. There are write-ups that have been done. You will always find, analysts talking about some of these things. So there's a lot of information that is out there. So can fundamental factors affect how the currency correlation works? Why, Marcy? I think I answered that. So I really appreciate your questions. What I will do is I will try answer a lot of these questions offline. But just be sure I'm going to answer all of your questions. All right. Because of time, I may not be able to do it now. But I'm going to answer all these questions. And just watch out for, the Instagram stories and all these other, platforms from Exness where I'll be answers to your questions. So thank you so much for joining today's session. It's been amazing. We've been learning mastering currency correlation. Now, for more insightful discussion sessions, trading demonstrations like this, make sure that you follow Exness Twitch channel. The one you're already in right now. Invite friends to follow. There is the amazing stuff that goes in there. So by following us, what you're doing is you're going to get notifications for our upcoming sessions. These will ensure that you don't miss. You don't want to miss this very valuable learning opportunities. So whether you're looking to refine, your trading strategies or you're just starting out in forex, it does not really matter. Our Twitch channel is a great resource to just help you stay updated, help you getting engaged with the latest trends in the market, conversations and techniques and approaches to the market. So join our community on Twitch. Never forget to follow and take your trading skills to the next level. We look forward to seeing you again in the future for more live sessions and live trading sessions. Until next time, have yourselves a lovely currency correlation as a way to measure how closely 2 currency pairs move in relation to each other. All right, just think of this currency pair that you're trading. Now, what's the relationship of these 2 currency pairs? So we use currency correlation as a way to measure how these 2 currency pairs are closely related. All right. It's like figuring out if 2 types of music beats, if you love music, you're listening to a beat with your headphones and you're listening to music and you're jamming to the music, or you've gone to a place you're listening to the music. Now you're thinking when you see a DJ play music, you will always try to synchronize the beat of the previous song to the next song. So it's the same way. So you're looking at 2 types of music beats which tend to play together in sync. If they're not, then it's still correlation, but it's negative. If it is positive. All right. Have you ever been to a party and you notice dancing to the beat, and you'll also notice there's someone somewhere who's actually dancing to the next beat? Okay, so I've seen that plenty of times. Or you've probably watched synchronized swimming. If you're watching synchronized streaming, you will always notice how fluid they are when they're walking towards the pool, and then they jump into the pool, and then they go about all the different routines and all that. Now, I want to let you know there are rules to those technical routines that they do, and judges will always award, best country or the best stream or the best team, rather, or a scale of 0 to 10. I did a research on this, so I know. So 0 in this case meaning that they've completely failed, then 10 being a perfect score. Alright, now you might ask yourself, how does this? Why does this example matter? When you talk about currency correlation, we're talking about a measurement. Now in forex trading, currency correlation then is measured using a scale, something called a correlation coefficient. Remember that score of the synchronized swimmers? Yes. 0, 10. 0 being they've completely failed, and 10 meaning that they're perfect. It's a perfect score for them. And that's how they win the gold medals and so on and so forth. So when it comes to forex trading, correlation is that scale of measurement that you call currency, or rather correlation coefficient, which is a number that tells you and me as a trader how closely the currency pairs are following each other in terms of movements. Let me break it down further. We have a currency or a coefficient correlation of +1 or +1, or what we refer to as perfect positive correlation. This simply means that the two currency pairs always move in the same direction. If one pair goes up, the other does the same thing. It also goes up. Now, when you talk about a -1, or what you call perfect negative coefficient, this means that you have two currency pairs that move in opposite directions. If one pair goes up, the other pair goes down. Then we have a third one, which we will not deal with today. Important for you to know, we have 0. We have a third coefficient we call no correlation, meaning there is no consistent pattern or relationship within two currency pairs in the manner in which they move relative to each other. No relationship whatsoever. So then, how do we calculate? I go into the math part of it, but just to give you a simple illustration, the correlation coefficient is calculated using historical price data. So when you're looking at your charts, you're analyzing your charts. What you might not realize, actually, you're looking at data on the left side of your chart. You are looking into the history. You're looking at the past of what price action has been doing. So when you're looking at correlation coefficient, you're using that historical data of the currency pairs. So when you're looking at first price movements of a currency pair, it can help you determine how similarly two currency pairs are moving together, or how they've moved together in the past. Are we together? Now that we know how to calculate, we understand why it's important to know what forms this. Let me also say something very, very important before I forget. As traders, we make money when the market moves. In other words, we gain from trending markets, or when the market trending, whether it's an uptrend or it's a downtrend, doesn't matter. So the strength of a currency correlation depends on 1. The time of what day and the current trading volume. Those two things are very, very important, and these two things are important. I'll give you an example. For example, pairs, which include the US dollar, whether as a base currency or quote currency, they will often be more active during the US market hours, or what you call the New York trading session. Alright, when you're looking at pairs that have the euro or even the pound, you will often see that these pairs are more active when the European and the British markets are open. Alright, so I want you to have that at the back of your mind. So when you're looking at price data in the past and you're looking at currency correlation and this coefficients, it's important to also know the particular time of day that you're looking at them, because the markets do change. Alright, so why do we analyze the bears? I want to put into the charts, but before I go just break this down so that when we now put the charts and look at different currency pairs, it will now start to make more sense. So why do we analyze? Why is it important for you as a trader to have these as part of your trading? Now, as a trader, you sit down to analyze your charts. Wake up in the morning. You're looking at your favorite pair to trade. Analyze these currency pairs using currency correlation. Depending on your strategy, alright. The idea is to find direction. That's number one. When you want to not get into the markets to buy or sell, you want fast to establish direction. Then the second thing you want to do is deploy your technical factors on entry points. You want a sniper entry. You want a good entry on a reversal. You want a good entry on just a minor retracement, whatever. it is that you want to do. The point here is you just want to get that breath. Alright, and that's important, but wherever you add currency correlation to your trading arsenal, what you're essentially doing is you're looking at two assets and their relationship using past statistical data, like I've said, to give you a predictive value. So the reason you're looking at this price data in the past, trying to predict the future value of the currency pair that you are trading. Alright, so I'm going to go to look at a few examples. This is going to be exciting. So I'm going to look at a correlation of -1. Or let's start with a positive. Let's start with a positive first before we can go to the negative. Shall we? So we're going to look at two currency pairs and how they move. All right. So I'm going to switch to the full screen so that you are able to everything that I'm talking about here. So we have with us two charts right there. All right. So correlation of +1 or +1. Currency pairs will move in the same direction nearly 100% of the time. All right. That is a perfect positive correlation. Now let's look at the Euro-US dollar. And I'm going to go to the charts right now and drag and drop the Euro-US all the daily time frame. And on my second chart, I'm going to drop the pound dollar. All right. Then close that so that you now can see that fully looks good. So I'm going to zoom. So you can look at this currency pair right there. Let me just move this slightly so that you have more looking room to the future. There we go. So when you're looking at the Euro-US dollar and the pound dollar, this is a good example. So if the Euro-US dollar is trading up, then the pound dollar will also move in the same direction. All right. Now that's the pound dollar. Let's look at another currency pair that is correlated positively to the pound dollar. Let me just give you the pound dollar for now. So I'll move the pound dollar to this side so that we can see our more examples. So that's the pound dollar. We've talked about dollar, whose correlation coefficient is around 91.7%. So this is nearly 100%. It's a very strong correlation, positive correlation. So let's look at another currency pair. For example, we drag and drop the Aussie dollar US dollar right there. Let's look at that. What do you see? You see same. It is around 81% positively correlated to the pound dollar. Let's look at NNZD USD as another currency pair. The New Zealand dollar against the US dollar 20. Close this right there. You see same thing. You'll see these currency pairs are moving in the same direction. So if we just try zoom that like that so that it's clear to your screen, we can see right there, so identical. The direction is the same. So when you have this moving to the downside, the pound dollar is doing the same thing, moving to the downside. So identical. Now these are basically major currency pairs and minor currency pairs. Now, how about we look at an exotic pair, for example, because more often than not, you'll find a lot of people are looking. Yes, I'm looking at the daily charts. For those who are asking, I'm looking at the daily chart. It's not the 1 hour chart, but I can go back to the 1 hour chart. And we can also look at these things. So this is what we have. The pound dollar, the New Zealand US dollar, it's going down. Now let's look at an exotic here. So we look at something that is positively correlated to the pound dollar, and I will think of GBP USD and maybe GBP Singapore dollar. So let me scroll down. Look at GBP SGD. There we have it. So, same now, thing. You will notice when you're looking at the pound Singapore dollar, you tend to see something there. Let's just... Their coefficients for this one now is a bit different. Remember, I'm looking at a monthly positive correlation coefficient. This is monthly, that is daily. So if you're looking at the daily correlation coefficient, it might be different. So what I'm dealing with here at the moment is the monthly. correlation coefficients.
All right.
You see, they almost look a bit different. So you'll see the percentages when they are so low, they're moving in the same direction, but they're not nearly perfect. It's not like what we saw earlier with a pound dollar, euro, US dollar. Now, what about a euro, US dollar? So let's look at currency pairs that are positively correlated
Euro,
to US dollar, which many traders like trading. I like this friend of mine who loves this. That's the euro, US dollar on a daily time frame. So if I drop odd card, let me try see our odd card right there. Let me just get rid of that. You see, same thing. You can see that odd card, but this one is 76.4%. So it might not look nearly perfect. Now, these are positively correlated currency pairs that you're looking at here. Now let's look at the pound dollar, and let's look at what is negatively correlated to the pound dollar. So we have an example here. Let's try use the card. Throw it on that sides. There we go. So that's a good one right there. So you have the British, you've got the euro, US dollar, the euro, US dollar going the opposite direction with the USD card. That's a negative correlation. So when one is going down, the other one is going up. Now, these things are so important for us to note. So when you're looking at a correlation of +1 or +1, shows that two currency pairs will move in the same direction. Not nearly perfect, but most times they'll move in the same direction. When you're looking at a negative correlation, it indicates that two currency pairs will move in the opposite direction. Let's look at another currency pair. This is the euro, US dollar. Let's look at USD Swiss franc CAD. Drag and drop. You see that still on the daily time frame. So when the euro is going down, the dollar Swiss franc is going up. That's the correlation I'm talking about. Now, if we drop down the time frames, because I'm seeing in the section some people asking, okay, so let's look at the daily time frame. Let's look at the monthly, just have some fun. Let's look at the monthly, and you can go on your charts or your access terminal and you will try these things. You'll see how they'll play out. You can go to the SNAS MT4, MT5. So this is dollar Swiss franc on the monthly time frame on the right side of the screen. Now the left side, I want to do the monthly as well. Let me remove that. So you see, when you're looking at the euro, US dollar, see what it's doing. Let's drop down to the weekly. This one is up. This one, the patterns are almost reflecting from one another. Let's go to the 4-hour time frame. Go to the 4-hour and I'll talk about time frames a bit later. I hope I'll not forget. Look at that. That's euro, US dollar on the H4, USD, CHF on the H4 time frame. That's what we have. So when we add this big news right here, you see this big red candle right here. So when people are selling, if you were trading the dollar Swiss franc and you're buying at the same time, you're making profit. Currency pairs, all right. We can look at more examples. We can look at, the euro, US dollar, and let's try. Look at an exotic, for example, and I'll try. Look at the dollar Polish zloty. Then we'll see if I can get it here. USD PLN. That's an exotic USD PLN. There we go. Let's see how this all looks. This is a law. Let's go back to the daily time frame. It looks so messy. The daily time frame, you can see that. So when one is going down, I want you to pay attention to this right here. See this move going down. It's the same move replicated on this other side. So when this markets went down from this point right here, the opposite is true. The markets went up from this level right here. All right. That's what you're talking about when we refer to the correlation coefficients and how they play out. And these things happen in forex all the time, every day. They happen every day. So if you train your eye to spot these correlations as we're trading, they will be so helpful to you. So this is the reason why we analyze these currency pairs. We talked about positive currency correlation, negative currency correlation. I can go on and so forth, but because of time, I'll not dwell on this so much. You can actually go and look at the positive correlations, negative correlation, and plot those charts on your screen. Drag and drop those currency pairs. Look at how they relate to one another, and it will really be helpful. So we've talked about the two correlations. Now, what about a correlation of 0? For example, let's look at a correlation of 0. This is where a currency pair has no relationship to another currency pair, and what comes to my mind is the dollar-yen as an example. So I drag and drop the dollar-yen on that side. And on this side, let me look for something different. Euro card as an example. That's the euro card right there. See, when you're looking at these currency pairs on a daily time frame, no relationship really. You might argue this one was going down, but look at the patterns. So the coefficient is not that really relationship there. Is not really there. So in summary, what I'm trying to say is the stronger a positive or negative correlation, the higher a predictive value is drawn from that analysis. Remember, we're doing this for purposes of predicting what value are we expecting to get from that currency pair. Alright, so if I'm dropping the pound dollar, if I'm trading the pound dollar and I'm trading the euro US dollar, which are the favorite most people currency because pairs they're going with the same direction, or even just drop the DXY as an example. Let me just drop the DXY. Oh, where is it? There we go. And we have the euro US So you want to know what is the euro going to be doing? So for you to know what the euro is going to be doing, the euro dollar what's going to be doing, you definitely go to the DXY. So when you're looking at the DXY, if it is going up, you are most assured that the euro US dollar is going down. This has always been like this. So if you're trading the euro USD every time you get an opportunity to trade the euro US dollar, this is what I do personally. I always go to check what is the DXY doing. This is on a daily time frame. So if today's price closes as a buy, because you can see the current trend, we are bullish on the DXY, and then you look at the euro US dollar, it's bearish. So these will always do the opposite of the other. Alright, so whenever you have a strong, you have a stronger positive. Or even a negative correlation, the higher you increasing your chances of predicting the value that is drawn from your analysis. So when you're looking at more extended time frames, I remember talking about, I mentioned this issue of time frames, the more extended time frames you have on your charts, or when you're using it for technical analysis, they will display more precise information compared to relationships over a 1-minute time frame, for example, which have a little value. So when you're looking at the monthly, so the DXY on the monthly time frame right there, the euro US dollar, all the monthly time frame. If you are going into the daily, the weekly, and the monthly, the data that you generate from that correlation coefficient generally will provide you the most reliable insight. At least that has been my experience. That has been my experience. So when you're looking at higher time frames and you're trying to get that predictive value, you will likely get some really good results rather than dropping down to the lower time frame. So you don't do this. You don't look at currency coefficients when you're scalping. For example, that's what you're trying to do. You're trying to look at the direction and establish so that if you are trading the pound dollar, if you're buying it, you definitely are not going to do the opposite with the euro US dollar. If you do, there's something terribly wrong with one of those currency pairs. And that's how many people end up making losses in the markets, because they lack that understanding of what exactly they're looking at. Alright, So let's go back to a couple of things that I want to mention, then we go back to the charts again. So why is this thing important? Why are we looking at this? Why is this really important? When you're talking about impacts and you're looking at these currency correlations as you're trading and you're looking at impacts, they can help. This is where now the rubber meets the road. When you're doing your analysis and you consider the currency correlation and all these coefficients you're talking about, they will help you fall a basis, all right? They'll help you for a basis, a structure, a plan. They'll help you for an objective of a statistically high probability for X trading strategy, or even currency pairs that you're trading. So if you're writing down a list of currency pairs and you go back to check on the currency correlation, they will help you follow up basis, a strategy and a structure and an approach to the markets. So there is no given point where you're going to have the dollar, which is positively correlated to the euro-US dollar. You will not buy one and sell the other. So if you have a technical indicator that you're using, that the market is doing that, then you go back to your notes and you check, no, this is positively correlated. I can't be doing the opposite. So I'd rather go the same direction. So the second thing it will help you. So when you're plotting these on the charts, they will help you. Illustrate the amount of risk. All right. The amount of risk that you are exposed to within your forex trading account. So if you're the person who's trading so many pairs in one account, you have, let's say, 10 currency pairs that you're trading. It's important to check each of those currency pairs. Are they positively correlated or negatively correlated? What you have in your notes. And that's why Trading Journal is so important, because you'll be able to mitigate risk and monitor your risk exposure. Once you knock off certain currency pairs and this one is negatively correlated and not going there. And especially for those who even use, if you're using signals, trading, whatever it is that you're using, you get a currency pair. You just don't hit the button. It is important for you to just figure out first, is this currency pair related to this other currency pair that I want to get into trading? If the answer is no, just leave that trade. Know your role in one. So just do a bit of more research before you get into the markets. The other thing, and as I talk about that, an example that is coming to my mind is if you have bought, for example, currency pairs with a strong positive correlation. All right, several currency pairs, strong positive correlation, then you are exposed to higher direction risk. All right, because if one currency pair goes the other way around, you are guaranteed that all your other pairs are also going to do the same thing. So this is the other point that is so important for you to note, that if you have 5 going in the same direction, if something just happens in the market and one of them reverses for some reason, maybe it's some news that has just come up, all the other 4 will definitely go the opposite direction. All right. So that's why it's important for you to be aware of risk when you're trading. You can also avoid positions that effectively cancel each other out. Like I said earlier, one is buying, the other one is selling. You are definitely wrong. So it doesn't matter whether you are buying one, selling the other, or selling one and buying the other. You are definitely wrong. So when you have that powerful negative correlation, if you have that directional bias, buying both Euro, US dollar, and USD Swiss franc, for example, will counteract each other. So you don't want to go that direction. The other thing that is important for you to note is when you understand currency correlations, then this will also allow you to diversify, like I've mentioned, so you can look at your trades within the day, or even within the week. You go back to your trading journal as you're noting which were the successful trades, the losing trades. Try learn from each losing trade. Every losing trade is a lesson learned. The first thing you need to do is, before looking at your technical indicators or anything else, look at you. Looking at your fundamentals. What went wrong? You will find that there was an issue with the correlation. So it's important for you to check on this. And if you have a directional bias for a given currency, you can then spread your risk using 2 strongly positive correlated pairs. That's in terms of diversification. So before I continue, please ask your questions. Let me hear your thoughts on the subject, comments, anything. Let's engage. I'll be taking your questions and answering them at the end of this live session. So now let's talk about trading based on correlation. Now, when two bears are highly correlated, one can serve. What's this now? One can serve as a leading indicator. Alright, of the price movements of the other. And I want to go to the charts, show you another example. So we are looking at this let me just go back to the Euro US dollar. I saw this some time ago. I hope I find something today. Just remember, this point is so important. That's the Euro US dollar on the daily time frame. Well, let me drop to our lower time frame, even a 4-hour time frame. We find more structures. We'd be in a short space of time. Let's go to the pound dollar. I'm using this too as an example on a daily time frame. Yes. There we go. So, part of the strategy when you're trading based on correlation, alright? When you have these two currency pairs that are so correlated, one currency pair. And this is a technique I'm just sharing with you. One currency pair, because you will never really find 100%, you know. Correlation. Sorry, this was supposed to be on inch force, there we go. Not daily. You will not find them being 100%. So the strategy here is use correlation and look at one currency pair. Study that one currency pair and see which currency pair is lagging and which other currency pair is fast and moving, because if you see a sharp move in one of these two positively correlated currency pairs, you can anticipate a probable move in the other pair. Let me give you an example. Let's look at this. Let's look at this 1, 2, 3, 4 candles right here. So when you're looking at these 4 candles, these are bullish candles. Now with this bullish candles, right? Let me just mark that. When you're looking at those 2 bullish candles, and let's look at what's on the other side, you're looking at this other currency pair. This is on the 4-hour time frame. So when you have this currency pair, this is 1, 2, 3, 4. This is 1, 2, 3, 4, 5. These are 5 candles that are bullish candles. All right. So these two currency pairs, remember, are positively correlated. Pound dollar and the Euro US dollar. All right. So when you're looking at one currency pair, always try and spot which one is lagging a bit, and you'll always see something. You will always find something. Why we use this strategy or technique when you're studying currency correlation, it is to help us that when we start seeing the market move to the upside. I'm looking at the Euro US dollar. My cursor is on the left chart, which is the Euro on the US 4-hour time frame. We're looking at these 4 bullish candles. Now, when you're looking at the pound dollar positively correlated, we have 5 candles that are bullish. So if you are trading the Euro US dollar and you are buying, this is on the 4-hour time frame, and you start seeing the market going up. One has already gone ahead of the other because the other one has a 5th candle that is bullish, although you'll see the closing price will be a bit different. If you're getting into 20 pips or 40 pips, a lot of times this is what this correlation will give you. So you will use one, and let me try and see if I can support something else. You will try drag this Euro, dollar. Let me zoom in a bit. Let me zoom in the pound dollar bit as well. Awesome. Great. Now, you see if we go back to this level right here, moving this too, remember correlation is not 100%. This one is around 91.7% to the Euro US dollar, these two currency pairs. Though there's that small margin. Now that small margin gives you this. Again, we're looking at this area right here. What do you notice? The market is actually going down. But what do you notice when you're looking at the pound dollar? You will notice something totally different. This market is consolidating right there. You see right there before this move we see here, this is what was happening. The market on the pound dollar was consolidating. It was not breaking out of this contraction or this consolidation of this pipe, so to speak, or the other currency. The market was still moving down. So question, if you are looking at the pound dollar and you notice there's a consolidation going on here, where will you find opportunity? I earlier started by making this statement. We make money in forex by moving, looking at and trading moving markets or trending markets. So instead of coming here and trying this thing out with a pound dollar, you'd rather then drop to the euro, US dollar, and continue trading. As long as this is making lower lows, you're looking at the pound dollar. It's moving sideways. You're looking at this. It's making lower lows. Then all of a sudden you see a breakout from that consolidation with this huge red candle. I'm looking at the right chart, which is the pound dollar chart on the H4 time frame, but you are already early in this other trade on the euro, US dollar. Because of time, I may not go into too many examples. Plot these things on your charts. Do a back test, and you'll start training your eye to see a lot of these things play out. So correlation can be even a more powerful forex tool for analysis, in conjunction with other forex indicators or technical indicators, your favorite ones. So if one pair breaks out, for example, breaks out above or below a significant technical level, whether you're looking at support or resistance, the closely positively correlated pair has a higher probability of following the same direction. Now let's cancel this, and I'll give you one more example before I go to your questions. So we're looking at the pound dollar. Let's change this. I show you an example of what I mean. Let's look at the pound dollar. Let's move the pound dollar now to the left. And then on this other side, let's look at the New Zealand dollar. S dollar, MCUSD. There we go. Let's show this to the daily time frame for good perspective. There we go. So those two currency pairs, right? So when you're looking at these two currency pairs, I see correlation in this case will help us. It will help us to identify if one pair breaks out over support. The other pair will be breaking out of a resistance. So the closely positively correlated pairs will have a high probability of following that same direction. So if you're looking at this currency pair, you get spotted this sometime last week. Let's see whether I can get it there. This is the New Zealand dollar, same thing. Let's move it there. We're looking at this one right here. So before this move, this is October 2023. Remember looking at this, but you can spot this anytime. So let's, for example, look at this right here. Price gets into a contraction. We're looking at the New Zealand dollar. Price is also getting into it. This contraction right here. Hope I've marked it correctly. When you're looking at price breaking out, see this broke out of this contraction to the upside, then the market was pushed down. So all of the stops that were somewhere up here on these swings, they were taken out, market went down. Same thing that happened here. So this will help you when you're looking at support and resistance. And you're looking at correlation. It will help you when one breaking out of support. The other one is breaking out of resistance. So if you notice two negatively correlated currency pairs and a significant upward price reversal in one of the pairs, then you can anticipate a potential downward reversal in the other pair. That's what you call price reversal, simply. You can trade the averages when you're looking at currency correlation. And that's also very important. Now I want to quickly jump into, because of time, jump into risk management. I really want to talk about risk management. And when you talk about risk management, when you're looking at currency correlation, the reason why this is one of my favorite things I like talking about is in terms of, managing the trades, where you set your stop loss and you take profits levels. When you're looking at defining risk, different people have different definitions. I'll give you one that works. There are so many, but I'll give you one that works. So if you're entering a trade, you decide you want to trade two currency pairs that are negatively correlated as an example. All right. So one is going up. The other one is going down. So when you're thinking of managing risk, so a common rule is to risk no more than 1 to 2%, right, of your total trading capital on a single trade. So if you're risking 2% on one trade, let's say is the S. Any trade that you want to enter, you want to risk 2% of that trade. But you want to trade another currency pair that is negatively correlated or even positively correlated. They're going in the same direction. So you will use dollar or pound dollar as an example. So how you are pushing this risk is the trade that you will enter on. Let it be 1% of your total capital. Then the other trade, let it be 1%. So in total, you've got 2%. All right, that's one of the proper ways of managing that risk. If you're going to have whether it's positive or negative does not matter. So what you want to do is you want to prevent significant loss and keep your trading accounts stable over time. So even if you've got good correlation, whether positive or negative, and you want to, win big, you want to gain more, you still want to apportion of risk to those two trades. So don't put 2% of one trade and 2% of the other trade. That's 4%. If that's not your trading style, otherwise you're going to blow up. Now, when we talk about stop loss as an example, generally there's a rule of thumb. You're looking at the stop loss. You're counting the number of pips. So you're looking at as an example, and you want to use your average true range to help you determine how far stop losses should be set before any recent market volatility as you're looking at it. So you want to measure from your entry point to your stop loss. How many pips are you risking? Then you do position sizing with that level of stop loss. If it is 50 pips, then depending on your account size, you want make sure that your account size and the 1 or 2% that you're portioning as total in your total capital as risk have divided it really well. So you will sleep better at night knowing that you have your stop loss there. Even if it goes against you, it's 2%. You've divided the 2% from the two trades. So you're basically in total risk in 2%, but running at the same time 2 trades. So those things are important. Volatility is also another factor. I will not go into those details. That's a story for another day. So if I address some mistakes that I've seen,